Hi, everybody. Barry McGuire here. It's Thursday, so it must be live at 5. Barry McGuire's Creative Real Estate Education Group. Today, we're very happy to have back Robinson Smith, and we're going to talk a little more about the Smith Manoeuvre. Robinson was on a few weeks ago, and we took about an hour and went through the basics of what's known as the Smith Manoeuvre. And there's a lot more to it than just the basics. There are a whole bunch of other tweaks and perks, what Robinson calls accelerators. And so that's really what we're going to talk about today. Probably Robinson will give us, a minute, 30 seconds or a minute on what the Smith Manoeuvre is, because we can't spend a whole hour reviewing it. That video is available for anybody who wants to go back and look at where we started out. But today we're going to we'll talk about what really can move the Smith Manoeuvre along for you, really make it work for you, really make it be faster for you. That's I think that's what we're going to talk about. So, with no further ado, let's bring in Robinson Smith, who can give us 30 seconds or a minute, Rob, for what the Smith Manoeuvre is, and then we can carry on with the accelerators.
Sure. Happy to be here, Barry. Shout out to Shaune, Impey, Smith Manoeuvre certified professional mortgage broker, who's joining us. He'll be chiming in throughout the presentation. But briefly, for those who haven't seen the one I was on, Shaune and I, a few weeks ago, the Smith Manoeuvre is a debt conversion strategy. Your mortgage in Canada and your principal residence is not tax deductible. What the Smith Manoeuvre does is it allows you to convert that non-deductible debt into very inexpensive tax deductible debt. And all the while you're investing for your future. You're starting this now, and these benefits happen immediately. So because you're reducing your tax bill, you're able to prepay your mortgage each and every year with the tax refund at the very least, and then you're able to reborrow that amount and get it invested. And because you're prepaying your mortgage on an annual basis, you're out of that mortgage much, much quicker than otherwise. So with the process, you're investing on a monthly basis with appropriate financing because you're able to access the equity you pay down each month with your regular mortgage payment. You're getting that invested, lowering your tax bill, getting rid of your mortgage much, much quicker. So we're seeing results of, 300, 400, 500,000 net worth improvement with just the plain Jane Smith Manoeuvre over the course of the original amortization. And maybe a 25-year AM is reduced to 17, 15, sometimes well under 10 years, as we'll see with the accelerators.
Okay, well, that, I mean, for anybody who doesn't even understand anything about mortgages, to hear that what they thought was going to take them 25 years to pay it down, that it could be 10 or 12 years, with applying the accelerators, that's huge. So I'm like stoked to hear how we can do it all faster. So let's dive into what you call the accelerators and
sure, yeah,
see how that goes.
And before I mention what I just described, this net worth improvement of $300,000, $500,000, getting out of your mortgage much, much quicker, it requires no new cash flow from the homeowner on a monthly basis. We're simply restructuring what you already have available to you, which is the mortgage. So we're going to turn that mortgage from your nightmare to your best friend. So if I can share the screen here, I'll give it a shot. And let me know, Barry, do you see that calculator now?
Yes, I can see the calculator.
Okay. So this is what we did last time we were on. This is the Smithman calculator. It's available at www.smithman.net. There's also a video demonstration, excuse me, on the website. But basically, last time I was on, Shaune and I, we just filled out this calculator. So I fill out my annual employment income. I make $150,000 a year. Let's say I've also got a rental property and it earns $36,000 in rental receipts each year, but it costs me $33,600 each year. So there's my net income. I've also got some assets. I've got mutual funds that I've had for a while. They're currently valued at $30,000. We'll see how all this plays in a moment. My rental property is worth $500,000. I've got emergency funds of $15,000. That's emergency cash. On my liability side, I've got credit cards. I pay a minimum of $300 a month. That's the minimum amount. And I can't seem to get rid of this $10,000 balance. It's always there. Maybe I want to consolidate it. I've also got a personal line of credit that I used for investment at some point. The current balance there is $20,000, and I make a $150 minimum payment on a monthly basis on that. $300,000 mortgage balance on my rental property. That gets my marginal tax rate here in BC 45.8. In Alberta, it'd be a little different. You can enter it in there, what the actual tax rate is. Here's my house, the one in which I live. It's valued at $750,000. The mortgage balance is $450,000, and I'm paying 3.1 on that. And this amortization defaults at 25 years. And here we go. That's what my monthly mortgage payment works out to be. Now, as Shaune will, Impey here, our SMCP broker, will be able to attest, a readvanceable mortgage has the typical amortizing loan that pretty much any mortgage has, but a readvanceable has, in most cases, a line of credit which is attached to it. So it's one mortgage, but there's two facilities. And on this readvanceable line of credit, this is where I can re-borrow whatever I pay down on that mortgage each month, whether it's just with my regular mortgage payment or with any of the accelerators we'll look at. If my mortgage payment reduces that amount owing of whatever my mortgage balance is by $1,000, the readvanceable line of credit limit opens up by $1,000, and I can pull that out. What I don't want to do with that new credit each month is make car payments, go on vacation. Maybe my wife would like me to buy expensive gifts for her, but in these instances, all I'm doing is replacing non-deductible debt, which I got to buy my house, that mortgage, with non-deductible debt on that line of credit, and my debt isn't changing one penny. So I'm maintaining all this non-deductible debt going forward. That's debt wealth destruction right there. So on this line of credit where I'm able to reborrow each month, the current rate of prime, I enter in whatever the factor is on the basis on this line of credit. Currently it's prime plus a half, so that gives me a borrowing rate of 2.95%. Now here's where the fun stuff happens. We get to this page and this defaults at 8%. You can type in 4, 3, 12, whatever you want in this investment portfolio growth rate. But this is telling the calculator what I expect my investments to grow at on an annual basis. And 8% is the default. So this number here, this is the amount, the 748, that based on the numbers I punched in on my mortgage, that very first monthly mortgage payment, most of it, some of it is going to go to interest. It's non-deductible. It's gone. It goes to the bank. Goodbye. But $748 is what reduces the principal owing on my mortgage. And when that line of credit limit opens up by $748, because the mortgage lender says, hey, you just paid down $748. We want you to borrow it back. Go ahead. We don't care. So that's what I'm able to re-borrow. But what I do with it is very important. I need to borrow with the reasonable expectation of generating income. That is what generates the tax deductions, which leads to the refund, which leads to the prepayment on an annual basis of that mortgage, which leads to it getting rid of it much, much quicker. So depending on who I am, what I want to do, I can borrow fully that 748 and get it invested, or I can borrow half of it, for example. Well, with the plain Jane Smith maneuver, I'm going to borrow all of that out, and this is where we start to see the results here. So the simple act of borrowing $748 from that readvanceable line of credit, remember my debt is not changing. I'm paying it down on the non-deductible side, but borrowing back on the deductible side. So my total debt is not changing one penny, but I'm getting invested almost $750 a month. And over the course of the amortization of this mortgage, right there, that simple action leads to tax deductions over the AM of this mortgage of over $108,000, which based on my marginal tax rate means the government over that period of time is going to send me a total of $50,000 back in the form of tax refunds. Fantastic. I like that. Now there's zero amortization improvement here because we haven't gotten there. But on the net worth improvement side of things, I have just improved my net worth by $384,000 over the course of this 25-year AM. That 748 getting invested each and every month at 8% growth is going to be worth $721,531 at the end of the AM. But that borrowing to invest means I've got a deductible investment loan of $337,500. So I subtract that from the value of the portfolio and I get a net improvement in family net worth of $348,000. Because if I sold $337,500 of my investments, I would be able to pay out this investment loan and still have $384,000 in the bank that otherwise I wouldn't have. Plus, I'd be clear title of the house. Not that being clear title of the house is the objective, but in any event, that's what we're looking at there. So I'm not going to go too much in depth here. Let's just say the lender will give me a full $600,000. They'll lend me $600,000, but I can improve my results by taking less than what they're willing to give me. And I'm going to do that. The math is a bit complicated, but what happens is my deductions increase and my net worth improvement increases as well, quite nicely, in fact. So at this point, do you wish to apply your estimated tax refunds to your Smith Manoeuvre? And this will complete the plain Jane Smith Manoeuvre, just the regular mortgage payment being used that I'm making anyways, whether I'm doing the Smith Manoeuvre or not, and taking those refunds to prepay the mortgage and then invest. So here we're going to see amortization improvement, and we're also going to see a net worth improvement once I select this. So now, just taking those tax refunds from the government annually and prepaying my mortgage is going to take 2.25 years off of that non-deductible debt, that expensive debt. And now my net worth improvement is $544,000. That right there, folks, is the plain Jane Smith Manoeuvre. 0 accelerators. This is the most basic version of it, and I'm at 444 net worth improvement. So portfolio of 939 offset by the investment loan, 544. Now we'll look at some of the accelerators and options of what I can do with my existing financial situation. The current financing that I've arranged here up to this point sees me with $100,000 of available additional borrowing power. Right on the day that I convey this mortgage, that I get it registered, not only am I paying out the mortgage that does not work for this program, but I'm also being given a line of credit with $100,000 of additional borrowing power. And I can do with this what I want. I can pull this 100 grand out and I can buy a Corvette. I can pull this money out, go around the world. I can pull this money out, go to Vegas and blow it all. I can pull this money out and throw it in the fireplace, burn it. The lender doesn't care. They've got the house as security. They're very comfortable. Now, obviously, what we do with this is very important. But in any event, with this $100,000 of available credit, we saw earlier on how I indicated that there was $10,000 in credit card debt that I simply wasn't able to get rid of. It was just hanging around and it was costing me $300 a month. I can consolidate this on top of my existing mortgage and pay a much lower rate. And so I'm going to choose to do that. And what we can do here is watch the numbers, the amortization improvement and net worth improvement. 2.25, well, not a whole lot saved there. Anything? No, not a whole lot saved there. But net worth improvement did increase. And that is simply by getting that $10,000 of debt invested over time. However, I indicated that I was paying $300 a month as a minimum payment. This is what they said. If you want to continue owing us this $10,000 credit card debt, says Visa or MasterCard, you need to pay us at least $300. Now I no longer have to do that because I paid those cards out. But I was already coming out of pocket by $300 a month going to the credit card companies. What I can choose to do is divert these salvage payments as prepayments against the mortgage. So this is no new money coming out of my pocket. I was already sending this to the bank. Now I'm going to send the same amount as a prepayment against the mortgage. Watch the amortization improvement. Watch the net worth improvement. 2.25 years and 558, 5.83, and 861. So my original mortgage of 25 years is gone in 19.17 years. And with an investment portfolio of 1.275, I subtract the investment loan, I get net worth improvement of 861. This just tells me my revised mortgage payment after consolidation.
Robinson, could I just pitch in there just for a
Sure.
second? I know most people know that credit card debt is extremely expensive, and we're talking about in these days of low interest rates, we're talking, sometimes under 2%, but 1.5%, 2%, 3%. How much would you be paying on that credit card? What interest rate are you paying, Visa or MasterCard?
Well, I don't think they've changed much. We're still seeing cards at 19.99. Generally, the math is you take you multiply the balance on that credit card by 0.03.
So this is
300 in this case. So 300 for the minimum payment.
Yeah.
Yeah.
So, I mean, so folks, it's always, always, always good. I mean, if you're talking about paying things down, if you're paying 20% interest on something and you have a chance to pay it down to a, really a tiny amount, that's always a good idea. And look at what a fabulous effect it had here when there's another $300 a month to pump into the maneuver. Okay, that's all I wanted to say.
Yeah,
I just want people to know
absolutely. I mean, effectively what we're doing is we're going from, say, 19.99% on that credit card on that 10 grand down to 3.1 after consolidation. So it's hugely valuable. So because I originally had, thanks, Barry. Because I originally had $100,000 available, but then I consolidated 10,000, I now have $90,000 available on that line of credit with which I can do anything I want. Now, I indicated earlier, as you saw, that I also have a personal line of credit with $20,000 in tax deductible debt. I borrowed that 20 grand to invest in something. And I've been maintaining it because I'm wise enough to know that maintaining tax deductible debt makes more financial sense than paying it off. I lose my tax deductions if I pay it off. And if I'm paying off my tax deductible debt with after-tax dollars, I'm necessarily not getting that after-tax money invested and earning the spread. 7-8% growth versus 3-4 something percent through the tax that I'm paying on the tax deductible debt. So I am going to preserve this. I'm going to maintain this tax deductible debt. I'm just now going to have it on the line of credit, secured line of credit. So obviously it's going to be a lower rate. So 5.83 years and 861, 6.08 years saved and 815. We saw that net worth improvement reduce. While we're out of the mortgage faster, we saw that net worth improvement reduce. Why? Because I'm taking $20,000 of investing power on that line of credit, and instead I'm paying out debt, albeit deductible. But this was costing me $150 a month when I was servicing my personal line of credit. So again, this is no new money. I can simply divert that as a prepayment against the mortgage. And we watch the amortization improvement and the net worth improvement. Now 7.5 years saved. What was it before? 6.08. That's just $150 a month prepaying that mortgage. And my net worth improvement goes from 815 to 965. So again, that's a $1.4 million investment portfolio. Subtract the investment loan, 965 net worth improvement. Okay, so those two, the consolidation and the preservation, are two things that I'm able to do. I don't call them accelerators. I'm just able to consolidate or preserve if it works out to my benefit. And that's all I've done here. But now we're going to start looking at the accelerators. And the debt swap.
Let me jump in for a minute there, Robinson. That's sort of like an accelerator. When people do accelerated mortgage payments and you put a little bit more on your mortgage, you pay twice. You pay biweekly. So you end up making that 13th month. So that saves you about 2.5 years. That was similar to that $300 example you had earlier there. So accelerated payments. So that's what a lot of the stuff we just covered is like making that biweekly payment to put more against your principal.
Yeah, no, that's exactly right, Shaune. So if you were going to accelerate your payments when you're not doing the Smith Maneuver, then you'd see good results. But as we just saw here, if you do these transactions that we were just looking at, plus accelerated payments, if you were able to, then these results will be further improved at this point. So debt swap accelerators, the first accelerator we're going to talk about. I indicated previously in this calculator that I had $30,000 worth of mutual funds and stocks. Now, I've got a PowerPoint presentation loaded. I can go through it later to really further cement how, graphically, how these accelerators work. But basically, what the debt swap means is this $30,000 in investments. I have the option to say, okay, mutual fund company, I want you to sell my mutual funds. I want that $30,000 in cash. Then once you do that, you're going to want to look at taxation. You got capital gains on the redemption, whatever the case may be. But now you've got $30,000 in cash. You can make a prepayment against your own mortgage. And then because of the readvance feature of this mortgage, that line of credit limit is going to increase dollar for dollar. So you pay down $30,000 on your mortgage, the line of credit limit opens up $30,000, and you borrow that 30 grand out and you get it invested. and you can buy the exact same investment. This takes 7 to 10 days to transact. So within 7 to 10, 12 days, maybe, you still have that $30,000 invested in the same investment you had before you sold, or a different investment, but you have just converted $30,000 of non-deductible debt to $30,000 of deductible debt. And that's hugely valuable. So here's the taxation improvement. You know, we've got to date $92,000 coming back to us in the form of tax refunds. There we go. If I do this debt swap, so I sell my mutual funds, I take the 30 grand, I prepay my mortgage, I re-borrow that $30,000 and get it invested, then I'm seeing my tax refunds increase. I'm seeing now 9 years saved. So I'm gone. That mortgage is gone in just under 16 years versus without doing this at 17.5. And my net worth improvement is now $1.2 million versus 965 if I don't do the debt swap.
So Robinson, in that particular case, with the $30,000 for mutual funds, I'm guessing that when you bought those mutual funds, you used savings.
Yes. And this is what we're going to talk about very shortly.
Okay.
I'm going to bring it back down into how we got that $30,000, how most people get that $30,000 of investments. Right after I do a couple of things here.
Okay.
So you're too smart. You're too smart, Barry. So also in the debt swap category is future lump sums. Let's say I know that in 2 years, I'm going to get an inheritance of how much? $10,000. And when am I going to receive this? I know in 2 years, in November, I'm going to get this 10 grand. So watch, as soon as I hit OK, it's going to register this. So watch the amortization improvement and the net worth improvement. Sorry, guys. There we go. 9.5 and 1.21. I don't know if that amortization improvement moved. It does improve the amortization, but like anything, when you start to compress something, like the amortization in this case, the more you compress it, the harder it gets to compress further. So there is an improvement there, it just doesn't register. But that net worth improvement jumped to 1.281.
You put 2020 in there, Robinson, instead of 2022, I think.
Did I?
Yeah.
I did. Do it again. I did that on purpose. I wanted to make sure you were watching, Shaune.
It's hard to put one by Shaune. He's pretty sharp.
2022, November. Okay, so there we go. 9.5 still, and 1.27 net worth improvement. So what this says is the calculator takes this $10,000 and applies it 2 years from today to get the results, rather than applying it today. Now, emergency cash, also in the debt swap category, I've got $15,000 in cash. People have been telling me all my life, you need to have X number of months in living expenses set aside in cash. And maybe I should, maybe I shouldn't. Everyone's going to make their own decision on this. Myself, what I'm going to do is I'm going to go out and get a personal line of credit for $15,000 if that's what I want for an emergency fund. And I'm not going to touch it unless there is an emergency. You know, and I'm going to rely on my wife when I tell her, hey, there's an old convertible, Alfa Romeo convertible. It's an emergency. I got to get it. I'm going to rely on her to tell me it's not an emergency, right? We got to be disciplined here. But instead of having that in cash doing nothing for me, earning less than 0% because of inflation year after year after year, I'm going to take that $15,000 in cash. I'm going to prepay my mortgage, and then I'm going to get it invested. So 9.5 years saved and 1.27 net worth improvement, 10.33 saved and 1.4 almost net worth improvement. So that 25-year mortgage is gone in 14.67 years. And my $1.8 million investment portfolio offset by $400 investment loan, 1.4 net worth improvement. Cash flow diversion. Here you go, Barry. Chomping at the bit. You are.
I am.
That $30,000 that I had in mutual funds that we already debt swapped here. The reason I had that $30,000 saved up is because I was investing each and every month straight off my paycheck You remember the wealthy barber? He says 10%, take it right off your paycheck and invest it. Well, that's what I've been doing, right? And it's been going into those investments to built up to 30 grand over time. How much have I been putting in each month? $300. What happens is each 2 weeks, let's say, I get my paycheck. It gets deposited directly into my bank account. And at the end of the month, I've got money in there. I say, hey, investment company, come into this bank account and take $300 and buy me more mutual fund units or stocks or whatever you're investing in. What I should be doing is when I get my pay comes into my bank account, instead of having the investment company come into that account and take it and invest it, I first take that $300 that I want to get invested and prepay my mortgage. Then that line of credit limit opens up by $300. I borrow that out and then I buy that investment. So again, this is no new money. Nothing to this point is any new cash coming out of my pocket to get these results. I was investing this $300 each month anyways. I'm still going to do that, but first I'm going to prepay my mortgage, then reborrow it to invest. And when I hit enter here, we're going to see the amortization improvement and net worth improvement go from 1033 to 1394 to 12 years saved and $1.68 million. Again, my investment portfolio is $2 million. Now this option here, the squeezed cash, this is new cash. I'm looking at these results. I'm considering the Smith Maneuver. My jaw's hanging open. I think, yeah, I'm going to do this. And you know what? This is the start of a brand new investment strategy. It's a brand new start to life for me. I'm going to get all my affairs in order. I'm going to do the Smith Maneuver. I'm really going to attack my financial security. And so I'm going to commit to coming out of pocket another $50 a month to prepay my mortgage, then borrow it to invest. And from 12 years and 1.68, that goes 12.33 and 1.7. This is $50 a month. That's all it is, right? Cash flow dam accelerator. I'm going to skip this one for a moment. And I'm going to go straight to the drip. So the drip is basically most people, what they do is when they buy an investment, if this investment has a policy of sending out dividends, maybe quarterly, biannually, yearly, whatever it is, most people say, hey, I want these dividends to be reinvested automatically. That's going to do great things for growth of this investment. And it is, is it the right thing to do? Absolutely, unless you have a readvanceable mortgage. The right thing to do, instead of having these dividends automatically buy you more units, you don't even see the cash. Instead, say, hey, fund company or company that's I own stock of, I don't want you to reinvest those dividends. I want you to send me those dividends in cash so that I can prepay my mortgage and then reborrow whatever that amount is and get it invested. I could buy the exact same fund or the exact same stock, but take that dividend in cash, prepay your mortgage, then get back at it. Now, some people will think, well, what happens about tax treatment? There is no change in tax treatment. Whether you're getting those dividends automatically reinvested each month or whether you're taking those dividends in cash, the tax treatment is the same. You're taxed in that tax year that you receive them. So here, if I'm taking this, if I'm doing the drip accelerator, I'm taking the dividends in cash and I'm getting them to prepay my mortgage. And what? 12.33 years saved. And now 14.9. So 10 years, that mortgage is gone in 10 years. And again, no new money out of my pocket at all in all of this, except for that $50. That's all. That's the only thing on it. In fact, I'm gonna get rid of that. Okay. Still doing really good things for our future security. This defaults at a 4% dividend yield. There's investments that send you 6. There's investments that send you 2. You can throw this around. Now, let's get into, for investment real estate, those who are interested, those who are looking to get involved or who are involved already in investment properties, this is where things get pretty exciting. The Prime the Pump Accelerator. Now, you'll recall the day I refied, thanks to Shaune Impey's fantastic work, into a readvanceable mortgage, I had $100,000 of immediately available credit on that line. I used 10 to consolidate non-deductible debt. I used 20 to preserve $20,000 of tax-deductible debt, which means I have $70,000 left over. I can pull this out, some, all, none of it. It's up to me. But what I can do is I can say, you know what? I've always been interested in investment real estate. Now I've got an opportunity to use $70,000 from this line of credit as a down payment on a rental property. And Impey's going to do that mortgage too. I like him so much. So what this calculator does, but you can pull the 70 out and do anything you want with it. I can invest in stocks, bonds, mutual funds, so a number of different things. What the calculator does is it assumes it goes into securities. I will at some point have an option to say, I want this to go in securities, or I want it to go into investment real estate. But this assumes that the $70,000, when I enter it here, is going to get invested in stocks or mutual funds or whatever that grow at 8%, as I've indicated previously. So if I pull the $70,000 and directly invest it, then we're going to see further changes on AM and net worth improvement. If we look at, now we're up to $122,000 in tax refunds. So this has just steadily gone up. I'm just sort of out of space on the screen here. But let's say I pull that $70,000 out and I get it invested directly, 14.75 years and 1.69, 15.92 and 2.1. I've got an investment portfolio after the course of 25 years, the original amortization here, of 2.7 million, offset by the deductible investment loan, gives me a net worth improvement of 2.19. Now, let's say I took that $70,000 out and I went to Shaune and said, let's go find me a rental property. Now we're going to start talking about the cash flow down. But basically, what this is saying, this net worth improvement, is this $70,000, if it did go to buy investment property, then that portion of the investment property that I bought with $70,000, if it were growing at 8%, would have increased my net worth that way. It's not a hugely comparable scenario here. But in any event, now I've got my rental property. Maybe I already had one. Maybe I go get a second one. In the scenario, in the values that I've already inputted here, you saw that in the income section, I've got a rental property that earns me $36,000 a year in rental receipts. It also cost me 34 and change in rental expenses. So here it's broken down monthly. $3,000 a month I'm receiving from my renters, and that property cost me $2,800 a month. So I'm barely cash flow positive, $200 a month cash flow positive. What most people do in this position, they live in a house, they got a non-deductible mortgage, it's expensive, it's killing them. They've also got a rental property, which is nice, it's doing good things for their future. But what they're doing is they're taking $3,000 from their renter each and every month and turning right around and making the mortgage payment on that rental property. So they're taking the rental receipts and using that to directly service the expenses on that rental property. What do I think they should be doing? They should be taking that $3,000 a month in cash, and you guessed it, prepay their own mortgage, the house in which they live. Now, if we're prepaying our mortgage by $3,000 a month on top of the regular mortgage payment, on top of a $300 cash flow diversion, on top, we're going to see some fantastic things happen. So that $3,000 I receive each month, I use that as a prepayment against my mortgage. That line of credit limit opens up by $3,000. I reborrow that full $3,000. $2,800 goes to service the expenses on that rental property, and the difference of $200 I can invest in securities. Now, the reason this works is because if we Canadians borrow with the reasonable expectation of generating income, we can deduct the interest. So if I'm borrowing to invest in my rental property, I'm borrowing to invest in my business. I'm borrowing in that to service the expenses of that business of which I expect to earn income. And indeed it does. So that's why I can deduct the income on that borrowing of $3,000 each month. So let's apply it. Well, as soon as I click this, we're going to see 15.92 and 2.1 change to 19.7 and 2.4. So investment portfolio of almost 3 million, net worth improvement of 2.4 million. And my 25-year mortgage is gone in 5.25 years. So that is where people who have investment real estate really start to get excited here. Again, this is no new money. They're receiving that $3,000 from the renter to begin with. Now, it's important to state that the cash flow dam works for proprietorships. So if I own a rental property, but it's in a corporation, things get much more complex here. you're really going to want to dig deep in with a Smith Manoeuvre certified professional accountant on how you can use that incorporated business to help you with your Smith Manoeuvre. But if it's a proprietorship, that business and you, according to CRA and the government, are one entity. You're not separate entities. So you can take those rental receipts, borrow, and service the expenses, and it's pretty slick. This proprietorship here, in this case, is a rental, but you can also do this with a home-based business. Let's say out of my garage, I knit sweaters and sell them online. It's not incorporated. It's a proprietorship. I can take my revenues from that business, prepay my mortgage, reborrow to service the expenses of that home-based business. So with what we've seen so far, the only thing I had indicated as coming out of my pocket was $50 a month. I've taken that out. So no new cash from my pocket, except for the fact that here, when I pulled this $70,000 out the day I got my new mortgage and I invested it directly, what the calculator does is it says, okay, buddy, you already had a mortgage of $450,000. Once you refinanced into the readvanceable, you were able to take $70,000 out. You're increasing your debt. Yes, it's deductible debt, it's good debt, but you're increasing your debt. And so the calculator says, I'm going to make you take that related interest of 172, which is what that 70 grand is going to cost me each month. I'm going to make you take that out of your pocket to prepay your mortgage and then reborrow it so that it's sitting there waiting to service at the end of the month, that new $70,000 of debt, that additional leverage. And the reason it does this is because, you know, if you can't afford to come out of pocket the borrowing cost of your new borrowing, maybe you shouldn't be doing it, right? So this, in this whole scenario and what we've looked at, the only extra cash on a monthly basis that is required is this $172 a month. The mortgage payment, I was making that anyways before I had the right type of mortgage. I'm going to continue to do so. The cash flow diversion of $300 a month, I was doing that anyways. The $300 to service a credit card, I was coming out of pocket anyways. The $150 to service a deductible line of credit, personal line of credit, I was coming out of pocket anyways. It's just redirecting what you already have going on in your life with the appropriate financing. Now, the next page here is, this shows what your numbers look like. The green line hitting 0 in 25 years is the original amortization of the mortgage. The blue line hitting it in 5 is the new amortization, thanks to the Smith Manoeuvre and the accelerators here. The purple line rising, we start to get this little box which gets in the way, but this purple line rising is the reborrowing. You'll notice that it's a mirror of the blue line going down. As fast as I'm paying down that mortgage, I'm borrowing it back to invest. This yellow line that goes pretty much horizontal is my total debt. So it is the sum of the increasing purple deductible debt and the decreasing non-deductible debt. And you'll notice it doesn't change over time. However, actually, I think, yeah, there we go. There's our investment portfolio. So there's just an explanation here in this little box that moves around of the values at any given point in time as I move along here. And then I can view and print a report. Sometimes this takes a while to come up, but come up it does. And the first section here is the assumption summary. It's just summarizing what I inputted into the calculator so I can print this off and show whoever wants to look at it what my plan is, right? What accelerators have I used? Did I consolidate? Did I preserve, right? Then the second section here is a summary of the results that's on the right side, the results panel. So it's just talking what the results are. And the last section, the monthly Smith Manoeuvre process, this just tells me, okay, I've entered that in November of 2022, I'm going to prepay by my inheritance of 10 grand. Here's my debt swap amount, comprised of the redeemed liquid financial assets, the mutual funds, plus my emergency fund, right? So, and here's my my monthly process of what I'm going to prepay each month. It's summarizing how much of no new money, and it's summarizing how much new money, and that's to cover the prime, the pump interest on that 70 grand. That's the only additional cash flow on a monthly basis. What are my withdrawals? What's my investment amount? That sort of fun stuff. So with that, holy cow, I think I need a sip of gin.
Me too.
That's not gin, that's vodka. I can smell it on you, Barry. Well, there you go. That's that.
Right.
We still have anybody on?
No, we have lots of people on. They're all speechless. So now that we've got that expansion of what the Smith Maneuver is, and because most of our folks tuning in are real estate investors, and of course they're interested in how this works for them on the real estate side of things, Shaune, I'm wondering if you have some comments for, how you analyze folks' portfolios if they have, a property, if they have 5 properties, if they have 10 properties. Do you look at things differently? How do you help out investors who come in and they're all enthusiastic about the Smith Maneuver and they go, Shaune, you're the accredited pro. Here I am. I've got 5 properties at various stages of amortization. I'm just wondering if you have some of your own accredited professional observations for real estate investors, Shaune, that would take what Robinson has said and focus it a little more for the folks that are tuning in who are real estate investors.
Well, I do, because when Fraser developed this, he developed it for homeowners with their own with one property, the one they live in, with a non-deductible mortgage on their property. So when you own 3, 4, 5 properties, you already have deductible debt because you can write off the interest on the property that you buy for a rental, right?
Right.
So putting accelerators against deductible debt makes no sense, because all you're doing is taking out deductible debt at 2.5% and borrowing it back at 3% or 3.5% on your line of credit. Well, that doesn't make any sense. So what you do is you recapture the regular monthly payments, principal that comes out of that, back into your HELOC. If you have, let's say your payment is $1,500, and in this environment you might get $1,000 back on your principal each month. If you've got 4 or 5 rentals, you're going to build up $4,000 or $5,000 in your HELOCs every month. You're basically, I call this the monthly refinance. So you get your money back. So after a year, you've got $60,000. That allows you to take that money and make a down payment on another property. Whereas if you didn't do anything with readvanceable, didn't do the Smith Maneuver, like the plain Jane Smith Maneuver on your rental properties, that money would be locked up in your properties. So you'd have to go back and refinance 5 properties to get out $12,000 out of each property. The other nice thing about the Smith Maneuver is that once it's set up and that money is flowing back on the principal, it doesn't really matter if your property drops a little bit in value, because it still stays in place. So if you had a rental property that was worth $300 and we're paying down your mortgage, getting $1,000 a month, and maybe a little softening in the market in a year, maybe it was only worth $280,000, $285 or something like that. If you went back and said, I want to refinance and get my $12,000 out, they might say, well, let's get the appraisal, and guess what? You're already at 80% of the value, so you can't take your money out.
Right.
By setting up a readvanceable with your HELOC in there, that money can come out on a regular basis. So say you're refinancing every month. So and I know there's lots of talk, you go into mutual funds and stock market and stuff like that, but you can save it up. You can put it into something safe and secure for a year or 6 months, and now when it comes time to buy it, you've got a nest egg building up there that you didn't have before. So I think that it's a great product to have on all your properties. So the other thing, when we talk about the mutual funds and that and the reinvestments and stuff like that, it's a good opportunity to get rid of your dogs in your mutual fund market, and because you can take the ones that have capital losses, and this is just my personal opinion, take your capital loss products that you may have, balance that off against capital gains and you may have a zero capital gain on products, so there may be no tax implications if you do it right. So that's an accountant financial advisor question, but that's just my take on how you might want to handle some portfolios that might have dropped in value. So
Yeah, and what I mentioned for everybody, it's very important you know this, is that the Smith Manoeuvre Certified Professional Accreditation Program I'm building out across Canada Smith Manoeuvre Certified Professionals, of which Shaune is one. So I'm training up realtors, mortgage brokers, investment advisors, mortgage conveyancers or real estate lawyers, insurance agents, and accountants. These are the people that the professionals that people should be surrounding themselves with in any event. But now you'll have these Smith Manoeuvre certified professionals locally. They'll all know each other. They'll all be trained not only in their profession, but in this strategy, because there's a lot of stuff that I didn't discuss over the past 45 minutes or 3 weeks ago, right? A lot of stuff involved. And so these professionals go through a course. They understand, like Shaune will know, okay, I'm going to place you in this readvanceable mortgage or that one or this one, depending on your personal situation. There's a lot of things that depend on this. And it's not rate. I mean, rate's always important, but this is way down on the list. If you get the wrong readvanceable mortgage simply because it's got a smaller rate, then you're running a real risk there. So that's why you need to talk to a guy like Shaune, not your banker, the mortgage specialist at the bank. He's going to put you in one readvanceable. Chances are slim it's going to be the best one. So you can reach out to us at info@smithman.net, and we can connect you with other types of Smith Manoeuvre certified professionals. A mortgage broker, he's on the call here. So
just to add to that, I mean, my job as a mortgage broker is to put you in the right product to get the best money back into your HELOC. My job is not to tell you what to buy with that money.
Correct.
So if you take my advice for investing, you might end up broke, and if you take my legal advice, you might end up in jail. So
that's actually the biggest risk of the Smith Manoeuvre, taking Shaune's advice for anything but mortgages.
Yeah.
All right. So, well, listen. Let's. There's lots of folks on. I think there's a number of questions. Wayne, why don't you pop us up some questions, and let's see what we can help people out with. I've been more watching what Robinson and Shaune have been saying rather than watching the chat box, but I see it moving along there out of the corner of my eye, so we must have a question or two. Now, all right, what does Karen say? Karen from Kelowna, thanks for hosting. Game changer question. All right. Number one, is a readvanceable mortgage when the loan to value, the LTV, is 80% or less, or on a 5 or 10% down?
80%. 80%.
80%. So, Shaune, what was the 65% in reference to HELOC?
The HELOC can only be a maximum of 65% of the value. So theoretically, that last 15% of your mortgage, you can't put it back into your HELOC. But over time, in 25 years, you're going to be refinancing your mortgage, so you'll be able to get more money out of your HELOC as you go.
Yeah, and that when I was demonstrating the Smithman calculator, I touched on it, didn't explain it. When I moved the slider from 600, which is what the lender was willing to lend me based on the house value, when I slid it down to $550,000, it improved my results. That's the mechanism which takes into consideration the 65% HELOC rule. So that rule is built into the calculator.
Yeah.
Okay. And question number two, what if you change your primary residence while you're actively working the Smith Manoeuvre?
Yeah, this is very common, and people move. There is a way to transfer the deductible debt that you've built up on the house that you're now selling over to the house that you're now buying. There's certain things that need to be done, and the real estate lawyer needs to be in the loop with the mortgage broker, but it can be instructed so that the buyer's money does not pay out your mortgage completely. Therefore, your new mortgage is 100% non-deductible again. The way it can be worked with certain conditions, if they're met, is that we transfer the existing deductible debt, as much of it as possible, over to the new house so you don't lose the benefit.
Yeah. So it's the rule on your money, as my non-accountant opinion is the rule on the money is where is it going? So if the money is going to you can basically refinance your deductible debt, then you have a lower interest rate, and you get in the right product with a couple of mortgages, you potentially could carry two mortgages on your house, one that may be there for the purchase of the house and be readvanceable, and the second one that would pay out on a deductible debt. And instead of paying HELOC rate, you may be able to pay mortgage rates on it.
Okay. And Karen has a third question, and I can only see a part of it. Number 3, is it recommended to automate what's the rest of that question? Donna's going to get that. Is it recommended to automate any of this? I'm pretty sure Robinson said yes.
Well, there's certain things you can automate and there's certain things you can't. There's no perfect Smith Manoeuvre mortgage out there. So the user, the homeowner, has to take some action on a monthly basis, but it's minimal. And each month you sit down and make your credit card payments, pay your utilities, do your Smith Manoeuvre transaction. Boom.
Yeah.
Right.
Some are better than others, the way they automatically increase and stuff. What you want to avoid is having a mortgage in place. That means every time you build up the equity that you can borrow, you don't have to go into the bank and sign paperwork and do that kind of stuff. You want your what's called not a limit increase HELOC that changes automatically and is accessible automatically.
Yeah. So folks, we've said it before that you really need to have a Smith Manoeuvre certified professional mortgage broker to do this. I mean, there's just lots and lots of product out there, and as advertised in a way that would make you think, hey, that's just what Robinson and Shaune were talking about. But you've got to have somebody like Shaune guide you through that process to make sure that you are getting the right product.
Absolutely.
I got a little story, quick story for you.
Sure.
I was working on helping a client refinance and stuff like that, and it wasn't a whole lot, and it was advantageous that the client just went into the bank themselves and talked to the senior mobile mortgage specialist, whatever they call themselves, and that person told my client that we don't offer that product here. And I won't name the bank, but I've set up many mortgages exactly like I told him to do, and so I had to call a mobile mortgage specialist and explain to her what her bank actually offers. So.
Always a touchy conversation.
Yeah.
Joan says, is the extra amount you put on mortgage only on the prepayment option, or could you also increase your payments?
Yes. If you have some banks have they call it 20/20. You can increase your payment by up to 20%, and you can put up to 20% of your original principal down each year. So yes, you can jack your payments up as much as the bank will allow and fit within your guidelines. You just don't want to run over you don't want to pay more than what they allow you in a year. Otherwise you pay penalties on it. But yes.
Is that, Shaune, when you're showing people through products, is that part of what you take into account, is that different banks have different prepayment options, 10, 15, 20, various combinations?
They do. And, some of them have a set number, but if you ask nicely, sometimes you can get the full 20/20 on just about any bank if you ask.
Right.
People don't know that. And even sometimes the amount in your line of credit affects the interest rate on your line of credit. So maybe more advantageous to start off with a higher limit
on
your line of credit to get a cheaper rate.
Yenga says, what's Yenga's question? How long does it take for the rental prepayment to become available in the line of credit and reborrow it to pay the rental expenses?
Shaune.
Should be the day after it's applied.
Yeah, you put it in there, you pay down, it should be right there, shouldn't it?
It should be, yeah. I can't tell you that all banks do that, but it should be there right away because you've paid it down and it's applied. So it should increase your line of credit right away.
Leona, we did talk last time about the Manulife One account, but if I recall, there might be a couple of different versions of Manulife One. And so, Shaune, tell us about Manulife One in this conversation.
I'm going to defer to Robinson because he does his Smith Manoeuvre in the Manulife One account.
Oh,
Yeah.
okay.
He's been through it live and has experienced it, so he can tell us some of the pitfalls with Manulife that you'd need to make sure you get corrected.
Yeah, well, the Manulife one is, regardless of how Manulife markets their Manulife one, for the Smith Maneuver, it's simply a tool, just like the Scotia Step is readvanceable, just like any other bank's readvanceable mortgage. They're a tool to have the Smith Maneuver function. The way that different readvanceable mortgages function is different across lenders. Manulife one is a tough one to wrap your head around. The way it operates, but once you get it, once you know what your operations are, it's really quite easy. I can do it online plus a phone call. So it's more complicated for the user, but once you get it, it's not that difficult. Now, I don't think they offer a variable component on the amortizing side. So that's one thing that an SMCP, a mortgage broker like Shaune, would discuss. So again, every readvanceable is different than the next. That's why you need to go talk to Shaune.
Well, here's an interesting one from Valerie. Any foreseeable issues accounting-wise, really, with applying the rental prepayments to the mortgage if you're renting out a part of your own home?
Yeah, there's no real accounting issues above and beyond the normal ones. Like if I'm renting out a basement suite and it's 25% of my home, the area of my home, then on my principal residence mortgage, I can deduct that from my income because I'm earning income from that property. But I can only deduct 25% of my mortgage. But that calculation still remains regardless if you're prepaying from whatever source and then reborrowing to invest or service the rental property expense.
You can deduct 25% of the interest, not the mortgage payment, just to be clear. So
yes, thank you, Shaune. That was another
25% of the interest. So if you prepay and have a little bit less principal, you're going to have a little bit less interest charge each year. So
yeah.
What's up next? Dax, how does cash down work with rental property owned in partnership?
This is probably going to be where you want to talk to a Smith Manoeuvre certified professional accountant. I'm not hugely up to speed on partnerships or real estate JVs. A lot of the finance creative strategies that you have, Barry, they're all relatively new to me. But an accountant will be able to sort out how the income and expenses are treated between the partners.
Yeah. And I don't know, he didn't really specify if that was a legal partnership or if he meant something like a JV or something, right, where your money comes back to you personally. So
yeah, folks, I mean, almost always when we're real estate investors and somebody says my partner, what they mean is their joint venturer. Almost nobody has a partnership under the Partnership Act here in Alberta or actual partnership legislation in other provinces. So yes, and I think last time I recall that we do now have some Smith Manoeuvre certified professional accountants. Do we have lists of people that have been trained up, or?
No, we don't have lists. What people should do is write into info@smithman.net and they'll be directed to a form. They can fill out what they're looking for, who they're looking for, where they are, their personal situation. That'll come to me and I can direct them. Okay,
well, I think that's very, very important information. What's that email address again?
info@smithman.net.
info@smithman.net.
Yeah, the website is smithman.net. It's also smithmanoeuvre.com. They redirect. I use smithman.net because even I screw up the spelling of maneuver every once in a while. So smithman.net's a bit easier to remember.
Maneuver is a tough one. That's a tough word. It is a tough word. All right. Next up, Shaune, are you suggesting we put a readvanceable mortgage on the rental properties as well?
Yes. It's how you refinance on a monthly basis to get your principal back. You can build up your war chest in your rental account. So if you have repairs and stuff or maintenance, and instead of having the equity locked up in your property and your furnace goes and you have a $2,500 bill, if you have to take it out of your personal funds because you didn't have a war chest in your account for that particular property, then that comes out of your, that's extra cash out of your pocket. And I think every rental property owner sometime has run into a case where they've got a bill for their property and they have to write a check out of their wages and stuff, where if you had a Smith Maneuver on there and you were building up your HELOC, you would have access to that cash and you could do those repairs or whatever was required for that property. It'd be tax deductible. So that's another advantage of the Smith Maneuver on a rental property.
So folks, for my simple mind, as I listen to this, for rental properties, I understand that my debt was already deductible, but I now understand my equity is trapped, and that's what we're trying to do, is make sure that trapped equity can be made accessible. Yes. Monica J., when you are several years into a mortgage on rental properties, on mortgage renewals, can you get readvanceable mortgage without requalifying? Okay, so
well,
what have we got? If the
depends
renewal
how
comes up?
Yeah, if it was set up and there wasn't a global limit on there, I guess it's lender dependent, but I would say that if you wanted to basically refinance and take more money out, they're probably going to ask you to requalify for a higher amount. You can certainly, at that time, you could change your product and have a readvanceable and a HELOC at that time for the amount that you still owed. But they may ask you to requalify if you're asking for more. So that's why it's pretty important to, when you're at 80% loan to value, get this in place to maximize your global limit to what you can borrow.
All right. Yeah, I guess that's the time to be ready to talk about changing products, is when renewal time comes up. I mean, I guess some lenders allow you to do it midterm, but yeah, everyone's situation is different, so need to have a pro look at it. What does Mike say? Go ahead, Shaune. Something else?
The answer to Mike's is yes. However, it's not accessible through the broker channel.
Right. Mike says, is National Bank's all-in-one a readvanceable mortgage? So when you say not available through the broker channel, that's what you are. You're a broker, so
yeah, they don't.
So you can't.
They're talking about coming back into the broker world, but they've been out it for a couple of years now. So, and brokers can't work with RBC, BMO, or CIBC. They don't work with brokers. They have all their own specialists. So, I get asked questions about, what can I do with RBC with my account? I can tell you what I think they can do, but if the best choice is for you to stick with your own bank, and for whatever reason, I'll just tell you to go ask them about, RBC, the home life, what do they call it? There's something, it's home something at RBC.
Yeah, home line.
Home line, yes. And CIBC is home plan, BMO is ready line. They all have some kind of a readvanceable product that's out there that's available. So if you're there and want to do that with your own bank, that's the best thing for you. I'll just tell you that's the best thing for you. So
yeah, but you got to remember as well, if Shaune says the best thing to do is to stick with your own bank, your bank mortgage specialist is going to know his product. He's not going to know the Smith Maneuver. So you're going to want some sort of Smith Maneuver certified professional, say investment advisor, or a consultant, and we can set you up with that, who can help you with the cash flows. What do you need to do? Once your mortgage is set up with TD or whoever, without a mortgage broker, we can help guide you from there, because there's things that are going to come up, like when you move in the middle of the Smith Maneuver conversion, when you're setting up in the first place the bank account linkages, you need to do it right, and a mortgage specialist at a bank is not going to have any idea. So again, info@smithman.net. Let us know what you're looking for and we'll hook you up.
All right, next up, joining late. Oh my goodness. Joining late. All right. Is the system still applicable even the middle of the mortgage, or does it have to be done up front?
Oh, it can be done at any time, as long as you can qualify for it with the appropriate equity and all that stuff. You're going to want to watch out for the penalty to break the mortgage, and Shaune can speak to that.
Yeah. So really depends on your lender. You can do, you might be able to do some kind of a blend and extend mortgage or something like that with any kind of a penalty included in the mortgage. And some lenders may just give you a readvanceable mortgage, but you gotta know what the interest rate difference is, because they're still going to want their pound of flesh, right? So if you're increasing the money, for instance, you'll get a blended rate. So it's best to set it up right from the beginning when you do it. Like when I set up Scotia or something like that, it has to be instructed right to Scotia when we apply for the mortgage. It has to be instructed, otherwise it doesn't happen at the branch. When you can't change your mind going in there and say, oh, I want an auto limit increase HELOC now, and I didn't get it set up in advance.
Yeah.
So make sure you talk to your broker before you sign any paperwork.
So folks, I hope you're getting it, that as much as there seems to be a lot of detail here, this is kind of a broad brushstroke. We're only spending an hour or so talking about it. I'm sure Robinson and Shaune could talk for hours and hours and hours. So really, it's the details that will make this really fly for you. So just keep that in mind. It's a detailed process that you need to go through to make sure you're doing the right thing for you. Let's get to more questions. Dax, what happens when a rental property is sold? Do we have to pay back all the cash down amount previously transferred from rental income to HELOC?
Yeah. Again, this is one for a Smith Manoeuvre certified professional accountant. They'll tell you exactly what to do here. But effectively, with this cash flow dam, I'm lending my business this rental property. These are loans on a monthly basis that I'm extending to this rental property. So when you sell that rental property, pay down that readvanceable line of credit component, and then turn right around and borrow it back again to buy a different rental property or invest in securities. So this is why the tracking of the borrowed funds and the use of the borrowed funds, having someone who knows how to track that, such as an accountant who's trained in the Smith Maneuver, means, okay, boom, I'm doing what I've been told. I'm only borrowing into my Smith Manoeuvre checking account, which is linked to that line of credit. I'm only using it to invest, whether it be securities or my rental property. And the only other use that I'm doing is to service the interest expense on that line of credit. So you stick to the plan. You don't deviate. We're dealing with the CRA here. We're dealing with mortgages and investments and all that stuff. This is why you need professionals. But effectively, not a problem. I sell one asset that I have over here, and I take the cash. I can pay down my line of credit, borrow it right back, and buy another asset.
Yeah. Well, you have to have a line of credit on a different property to be secured, right? Because you got all the caveats and encumbrances on that property have to be paid out when you sell it, right? You can't have any line of credit left secured by that property. So.
Yeah, I think Dax was asking about the line of credit secured by your principal residence that you borrowed to service the expenses.
I think he was talking about one with a rental property there. So if you're building up your line of credit on the property and you borrowed against it, then when you sell the property, you have to pay out the underlying mortgage. You also have to pay out the line of credit because the security is attached to that property, right? So I think that's the question he was asking. So.
Well, we might fight about this.
But that's an accountant question anyway. So
it is.
Yeah.
Okay, here's one for Robinson. When paying my rental house mortgage out of a Manulife One sub account, is it a problem that I can't transfer the money directly out of the sub account? I have to pay the mortgage with the main account, then transfer the equivalent money out of the sub account to keep track of the rental home mortgage payments separately.
That's what I do. Everything gets paid from that main account, and then you just transfer the debt that went to your investments, plus the interest on that borrowing to invest. You transfer that debt over to the tracking account. You do that on a monthly basis.
All right. That was an easy one. That was a long question with a shorter answer. Excellent. Wayne, do we have any more? I think your answer is yes, we do. So just to clarify, a readvanceable mortgage is a type of HELOC and can only go up to 65% loan to value.
That is not quite right. So readvanceable mortgage can be 80% of the value of the property, loan to value, the HELOC can start off at any amount. It can start off at $1 or $10,000, $50,000. It all depends on your circumstances there. So what's limited to 65% is the HELOC can't, if nothing changed, your house didn't increase in value over the length of time you're paying down your mortgage. It's like two components. There's the mortgage component and there's the HELOC component. Oh, my hands are backwards. I can't figure this out. So, so as one goes down, the other one goes up. But you can't pay your readvanceable mortgage down to zero and put all that money into the HELOC. It can't be, your HELOC can't be 80% of the value of the property by law.
So your non-deductible debt, mortgage debt, may start at 80%, but once you're finished that conversion process, you'll have no more non-deductible debt, but you'll have 65% deductible investment loan debt. That's why in the calculator we started out with a $450,000 non-deductible loan. But when I was showing the net benefit and subtracting the investment loan from the portfolio value, you may have noticed that it never was at any higher than $450,000.
Yeah. So
Right.
you could certainly go apply to increase your global limit on your property and not take money out.
Yeah.
You know, and it would increase your global limit, so then your HELOC would increase higher. So there's lots of different things you can do with it. So I don't think it's, you know, it takes a long time to pay down that $400,000 mortgage to get that up where the property, you know, theoretically properties go up every year, right? For us who bought properties 5 years ago.
Theoretically.
Yeah, there's ways to do
Theoretically,
the 5% rule such that you're converting as much of that non-deductible debt as possible. It may be the case that there's some that you don't end up converting, but it's minimal.
All right, next question. How would you separate interest on tax time if you have two rental properties and use the Smith Maneuver to service both of them?
Well, if you've got the right type of mortgage, I mean, you can get separate components like maybe 5 different lines of credit or tracking accounts that you can separate the different properties on your principal residence mortgage. But also you're going to have statements from your mortgage lenders of the two properties which said, I took this much for the year from your account and I took that much for the year. So keeping all your statements will be able to clearly indicate how much went to where.
I think that's right. Okay.
it's never a bad thing to have more than one bank account. That's my bank account is my bookkeeper. I keep a different bank account for each property or group of properties that are with a joint venture partner. So all you have to do is have 12 bank statements at the end of the year and you got your bookkeeping all done.
Yeah, keep them all separate. It's a bank account for the property, nothing else.
Costs $5 a month for a bookkeeper, basically. So,
Yenga, is it possible that the savings portion be lower due to market fluctuations at the end of the amortization?
Yeah, if the world fell apart and never recovered, then maybe your investment portfolio is less than what you owe on the investment loan. This is as long-term a financial strategy as it gets. This is till death, right? The idea is to convert your mortgage to deductible debt and maintain that deductible debt. Even after you've finished the conversion of your mortgage, keep that deductible debt. Because if you're paying down that deductible debt with after-tax dollars, that you're reducing your tax deductions, you're also necessarily not getting that money invested for growth. Now, by maintaining your deductible debt, you have as much invested as possible. Sure, at some point, well, it also depends on what you invest in, right? I mean, this isn't borrow to invest and go to Vegas and spin the roulette wheel. We're not gambling with this. We're doing wise, growth-oriented, stable, blue chip stuff. Now, I'm not here, nobody's here to tell you what to invest in when you engage in the Smith Maneuver. That's between you and you know, it's what you want to do, where you want to go, what you're comfortable with. But theoretically, yes, it's possible that my investment portfolio is worth less than the investment loan that I accrued to acquire that portfolio. But again, you look at the index charts, you look at the markets for the past 70 years, and Canadian equities have averaged maybe just under 10%. US equities have averaged a bit higher. Real estate's done pretty well. We're not getting in and then getting out, 2 years later. This is long-term stuff, and that greatly flattens the market and interest rate risk.
Yeah, it's long-term, folks, long-term. And the best time to get started on this probably was a few years ago. But the next best time is right now. Let's make sure that we know that you haven't missed out. If you haven't done any of this yet, if you haven't investigated the Smith Maneuver, it's not too late. The time to start is right now. Harry says, if you are increasing your global limit, aren't you refinancing the property?
Yes, you're going there for refinance. It doesn't necessarily mean you got to change the products that you got, though. So you don't have to change your readvanceable mortgage you got. You could add another product to take the rest of the money out, another fixed rate mortgage, or increase your HELOC amount, your limit. So depends what product you're in. Some only allow a readvanceable mortgage. Some only allow it on your principal residence. So MCAP only allows on principal residence. So they have a good product because they let you have $1 to start. Scotia lets you have different components. Manulife lets you have different components. So you are refinancing.
Okay, very good. Oh, this obviously is striking a chord with everybody who's watching. There's a ton of old questions, as they say, including Yenga, who's hogging the questions. What's up, Yenga? No, just kidding. You're entitled to ask as many as you want. Are there any investment vehicles you recommend over others? I know the answer to this one.
The
Corvette.
answer is no.
Corvette. That's a good vehicle, Corvette. Yeah.
I do not recommend any investment vehicles. I'm not an investment advisor anymore. You aren't my client. I don't know you. I don't know your goals and objectives. I don't know what you understand and what you don't. So this is where you collaborate with a Smith Manoeuvre certified professional investment advisor. They will get to know you. They will get to know, do you have a family? Are your kids going to school? What are your goals in life? What's your timeline? Risk tolerance, all that stuff. And then you determine what you're most comfortable investing in.
Hey. Further to my question above, when I transfer the $3,000 to pay the rental house mortgage out of the main account, am I not just transferring $3,000 out of the sub account in order to keep track separately? I think Robinson said to transfer the $3,000 plus the interest. Did I misunderstand that? The part about also transferring the interest confused me a bit.
Yeah, I don't think you misunderstood it. It's just not something I've explained in great detail, if at all. But each month when I borrow to invest, let's forget about the rental property. The fact is that I'm borrowing to invest, whether it's in the rental property or whether it's in securities, on a monthly basis. So if I borrow $1,000, well, we'll stick with $3,000. If I borrow $3,000 and invest it, that's great. That's month number one. The second month, the amount of principal reduced is greater than the first month because of the increasing efficiency of the regular mortgage payment. Less goes to interest on an ongoing basis from that mortgage payment. Therefore, more goes to principal. So the second month, I'm able to reborrow $3,050. I invest that $3,000, which leaves $50 left over. And that is what services the increasing interest on that deductible line of credit. This is why it doesn't take any cash flow to do the Smith Maneuver from my pockets. Now, with the Manulife One, when I'm getting that $3,000 invested each and every month and sending that $3,000 to $3,000, $6,000, $9,000 on that tracking account, I borrowed that money, so I'm paying interest on it. But the Manulife statement will show you how much you're paying in deductible interest on that borrowing. And so you also want to get that into that tracking account. So month one, you've got a $3,000 balance in that tracking account. Month two, you add $3,050. So now you've got $6,050 because $6,000 was invested, deductible use. The interest on that borrowing was $50, and the interest on interest that is deductible is also deductible. So the fact is that you want to track the amount that you borrowed to invest. You also want to track the interest on that borrowing to invest. So track that all together in that sub account.
Folks, can you see why you need some real trained pros to do this? I mean, this is not something you're going to really set up or do properly on your own. I know we said that a bunch of times, but, and we always talk about when you're investing, you need a team. Well, this is raising the notion of you need a team to another level if you're going to take a particular strategy like this and really make it fly for you. And let's face it, that's what we want to do. We want to take the training and the thoughts that Robinson has kindly given us, and really get to understand it. And so I see notes in the chat about reading the book and taking the course and how valuable that all is. But you're still going to need a solid team around you of pros who understand what's going on. All right. Well, we're coming to the end of this. I think we're almost at the end. Yes, we are, according to our producer Wayne, our IT guy. Well, Robinson, it's a delight having you on here. You put so much effort and time into this. You know all this stuff up, down, and sideways. You're a great presenter and a great answerer of questions. Shaune, it seems like you know a thing about it or two. I wasn't sure about you, but I'm pretty confident.
I got a certificate.
I got a certificate.
Yeah.
No, just kidding. I know that you know a lot about it. You've put a lot of effort in. And folks, I have to say, Shaune is like Robinson, very generous with his time. Yes, he's a broker, and yes, he wants to get paid, and yes, he does consultations and wants to be paid for them, but he is very generous with his time. And if you want a guy who thinks deeply about these things and who is really plugged in, and you need help on a specific mortgage broker level, then make sure you get in touch with him. That's very, it's very important. So I want to thank you, Robinson, for showing up again and doing such a great job. Shaune,
it's always free to talk real estate. So
yes,
well, I'll just sign off by saying I'm not so generous with my time, so I'm going to be sending you an invoice, Barry, for this.
All right. Hey, listen, nothing free in this world. It's worth every penny, I'm sure, when it shows up. Donna, remember that. Well, what? Donna's sending a bill? Hold on here. All right. Well, we're going to sign off now. Thanks again, Robinson. There's Shaune's details on the screen, so you can get in touch with him. Shaune, thank you very much. Wayne, thanks for all your work in the background. And folks, that's another Live at 5, and successful too, I might add. Good night, everybody. Talk to you soon.